talking about price levels.
Oh, yeah. Axon, Scottsdale company here. This is the body camera company.
So on this particular day, we opened here. Obviously, there was some kind of news right around 540. So a lot of volume traded there. But guess what? A lot of people sold on the open that are like, oh, man, this sucks. I sold on the open and the stock just blasted off and rallied the whole day. If it ever gets back to my price and I can get my shares back where I sold them, I'm going to. So on this particular day, what's the low trade here? Low trade 543.48, and the opening trade here was 540, right? So within a couple of points of each other. Now, if you were trading this and you were thinking, boy, this Axon, whatever news is driving it, maybe it's bad, but it's not as bad as people think. I think the market's overreacting. Where should I go in and buy this? Maybe I'll have my price target somewhere around where there was support over here. And sure enough, you could have pretty much bottom ticked the market. I mean, hindsight's 2020. Now, again, here we come up into the present. We go into this big sell-off here, 16%. Then we get a 8% sell-off. And look at where we found support. So we're just kind of hanging out here. So I think that when I see something like this, what really kind of excites me is for a potential idea on the short side, is it's support that's above what was a gap. So one of the main reasons why we get support, as we saw, is because we have seller's remorse. People sell, and when the price goes higher, they want to buy their shares back if they can get them at the same price they sold them at. In a situation like this, where you close at this price and you open at this price, there's no trading in between here. So we call that a gap. And if there's no trading, well, guess what? Then there was no one who sold who is going to be trying to buy on the way back down. So if this support breaks and the stock heads lower, there may not be a lot of buy interest. And that would make, that would have a tendency for the stock to move through these price levels really quickly, because the sellers are really going to need to hammer it if they want to draw buyers off of the sidelines. And then your support would be down around 465. So that's 80 points there.
Yeah, exactly. So real quick, let me fill in some context here, because first of all, I love the setup, the chart. This is a great look at a chart that you've picked here. Not surprised at all. That big red stick that took us from 700 down to what looks like 600 there, that happened on Wednesday, February 19th. We actually heard, we had Benzinga Pro, shout out. I had a rumor in the morning that an Investor's Business Daily swing trader was selling stock. This came ahead of several downgrades the next day. So you actually had Craig Hallam downgrading the stock to hold and announcing a 625 price target. And the interesting part about this is that this comes ahead of earnings. Earnings are in 4 days here, Tuesday next week after the close. So you're getting Investors Business Daily swing traders selling. Then you get a downgrade the very next day on a stock only 4 days ahead of earnings here. So to your point there about a potential short, maybe you get even more bad news here from that earnings print, and you have a possible gap fill below that line.
Yeah, I would have to. I haven't looked at the earnings report, but but there are certain things to look for in earnings, which you don't need to be like an expert to understand, right? Like one is you want to look at what we call the operating margin. And that's just if you take the income and you divide it by the revenue. And whatever percentage you get, say it's 5%, that shows you that the company earns 5 cents for every dollar of sales. If it's 8%, then it's 8 cents. If that's going in the wrong direction, if that's going down, then that could potentially be pretty bad for a company. So sometimes companies beat on earnings and the initial reaction is for the stock to go up. But as people look more into it and say, wait a second, even though our sales are going up, we're becoming less profitable. So that could kind of hurt us, or I should say we're becoming less efficient. So in the long run, that could be a bad sign. Another thing you want to look at that's pretty simple to figure out is if you're looking at a retail stock or any stock that has an inventory, look at the balance sheet and look and see if there's a big inventory buildup. Because if there is, what does it mean? It means that stuff is not selling. It's going into inventory. And when that happens, they have to reduce their prices to sell. Another thing to look for is GAAP versus non-GAAP, right? You'll see a company will report earnings that are GAAP, GAAP, and non-GAAP. GAAP is generally accepted accounting principles, right? And let me just use one of my oft-used analogies. Say a company makes $10 million a year and they have a factory that burns down that cost them $1 million, right? So that means they would only make $9 million that year. They could come out and say our non-GAAP is we made $10 million because that was a one-off. That's not going to happen again, right? So sometimes the non-GAAP numbers will look really good, but if you look underneath them, it's like, wait a second, these numbers are not as good as they think. So those are just three things that I look at when a company releases earnings.